But it's focus oil and gas, in particular Reliance Industries. Jal Irani, Senior Vice President, Institutional Equities Research at Edelweiss Securities, is on the show with us. Jal, hi, good morning. Great to have you on the show as always. Help us understand, Jal, how is it that one should be looking at the valuations of Reliance Industries, given the way its business model has been evolving of late?
Well, just beyond valuations, I think Reliance is in a sweet spot. Essentially, the company has made very significant investments, which exceed, in my opinion, about $70-80 billion of capex. And now that capex is in the process of coming to fruition. So the one stated goal of the chairman also in the AGM was that their EBITDA is going to rise by 15% CAGR, if I'm not mistaken, at least over the next 5 years. So firstly, it's getting into a high growth phase with a 15% EBITDA growth, and a lot of these businesses have high fixed costs. So therefore, its profit growth may be even net profit growth maybe even faster. And coupled with that, now their stated goal is to be net debt free in 2 years. And in fact, to be net debt free, they will be having a very large positive free cash flows. So here is a company which is in a high growth phase, and in fact the risk profile is plummeting, and therefore we are looking at actually a company which is transforming itself especially in a risk averse environment. It's transforming itself to a relatively low risk platform, and therefore we think that it's really in a sweet spot.
Right. How is it that you analyze their plan to delever themselves at a consolidated basis for the next few months? Because some people on the street are reading this as a sign of caution setting in. What would you say about this argument after the AGM?
So you see, firstly, that they have got a net debt of a little more than 2 lakh crores. And once the Aramco deal is fully complete, the net debt should fall to less than 1 lakh crores. With basically an EBITDA in the region of about 1 lakh crores this year itself per annum and rising, therefore it would be in a net debt situation fairly quickly. Now, one needs to understand that debt world over has become a bad word, and while there is a certain amount of merit to be taking a certain amount of debt, at the moment I think investors are punishing companies with high debt and rewarding companies which are actually not taking on debt or repaying debt. So I think in this current context, it's a good thing that one doesn't have debt. Notably, if I may add, eventually one should have some debt on your books, because that reduces your weighted average cost of capital. That may, in my opinion, happen a few years down the line, but I think the first stated goal of being a no debt company, and hence in this risk averse environment, actually is a good thing. Needless to say, we saw when the chairman announced that there could be no debt company, the stock price rocketed. The point being that the market sentiment is actually reflected that the market doesn't like very high risk companies, basically.
Okay, now let's talk about the weak refining margins, because that's way down on the company, not just now, but for the past few quarters as well. From here on, do you see that change or, show some sort of an improvement?
Firstly, refining margins, even if you look at Singapore benchmarks, have shot up currently versus the last quarter. So just from memory, so firstly, you're right. The last few quarters, refining margins have been very low. But last quarter, Singapore complex, for example, I think was about $3.50. Singapore complex now is $6.50. So, you know, we've seen very tough times in refining, and the bottom has been reached. Now, the next 2 years or next year and a half is still going to be difficult, but in my opinion, not as bad. So you are seeing in the next 1.5 years capacity increases, which are potentially going to exceed a relatively weak demand environment. Yet the capacity utilization rates globally are not going to fall dramatically. I mean, they're in a fairly high range of about 83 odd percent. They may fall by about 1%. So you're not actually not in a, you're in a reasonable situation despite sort of things being cyclically low for the next year and a half or so. But the bottom has been reached, you know, last quarter, in my opinion. Now, if you extrapolate two additional things on that, really beyond the next year or so, globally you aren't seeing significant capacity increases. And the reason for that is that there is this big fear that you will have peak oil reaching in about 2030, 2035. And if you set up a new refinery, it takes you 7 to 10 years. So therefore, refineries are not being set up. So while refining demand is still going to increase for the next 15 years or so, you're actually going to have gross refining margins going up because you are not getting supply globally. And the third part to this answer is that if you look at the refineries domestically, refining in India is a very robust business. Refineries in India are extremely competitive, one of the most profitable in the world. And petroleum demand growth in India is going to continue growing for at least the next 20 years, if not beyond. In fact, BP Energy has got a forecast that India will, by 2040, consume 1/4 of the world's energy consumption. So in sharp contrast, India has got a significant scope for new refineries. And the Indian refineries are not only progressively expanding, but more importantly, they are enhancing the competitiveness. So what they're in the process of doing, and including Reliance Industries, Reliance has just increased their complexity, which is a measure of the ability to produce more of the higher margin products. It's just increased its complexity from about 12.7 to 21. And what that means is that they're going to be producing more of the high margin products and less of the negative margin products. So one is that while near term there'll be some pain globally, longer term actually it's a fantastic business over the next 15 years. And thirdly, in an Indian context, it's an even better business. So I think that is a very strong business for Reliance.
Fair enough, given the context of the way we've seen the overall refining margins shape up. And what kind of a transition can the home broadband business get in your view? Any numbers that you've worked out roughly?
I think it's very preliminary. Reliance itself has announced a formal launch only starting September. Now, we think that they could reach a break-even point in this business fairly quickly because they really have the backbone. They have set up the infrastructure. It's a function of last mile connectivity and spending a bit more on last mile connectivity. There as well depends on what the model that they'll follow. But if they actually take deposits from the customers, which in my opinion they would, then actually the incremental cost of that business is insignificant. And typically the EBITDA margins in this business can be as high as 60-70%. So therefore the cash break even in this business could be fairly quick to that extent.
Okay. We'll let you go on that note. Thank you so much for taking time out and really helping us to understand rather the business of RIL in terms of all of the segments that they are looking at. So as of now, RIL, you believe, is in a sweet spot, and there is potential given that they are moving away from a high risk profile.